All right. So, what my intention is today is to give some perspective in terms of why property investors, how we're unique, what our unique offering is, and our value proposition versus the rest of the industry, and therefore how that sort of fits into our successful affiliate program and why we've had such a successful, long-standing affiliate program. And I would argue probably one of the best, maybe even the best affiliate programs in the industry. There's a number of reasons for it because it's all been purpose designed and purpose built. So that's my objective. I also want, as part of that process, I want to sort of show you what is the difference between the business models and also how that plays out for the outcome of our clients, because that's the most important thing that our affiliate partners are interested in is how their client's going to be looked after, how their client's going to actually perform in terms of their investment, because it's obviously a big trust to place in referring their client across, and it's really, really important. So let me share my screen and we'll go through that process. And essentially, we've got a number of different materials that if you haven't got, you can request. But usually our new affiliates will receive the materials that we have in terms of actually a background on the company and our affiliate program. So essentially, our industry is pretty stinky, all right, as a general rule. I've been in the industry for 30 years. I've been investing since 96 myself. And what I've observed that the industry has done, not only since the 90s, but probably going back as far back as the 80s, is that there's a lot of two-tier marketing. There's a lot of manipulation of prices that marketeers will get in bed with developers and builders. They'll increase the price. They'll take more commission. And on a $500,000-$600,000 property, they're taking outrageous $50,000-$60,000 commissions. And how's that even afforded? Well, it's afforded by the fact that the price is manipulated with two-tier marketing. That means that the investor loses, their valuations don't come in, they've got to tip more money in, usually coming from equity in their home. They don't have a good experience, but even if they did have a good experience, they can't come back and do it again. And if an affiliate has referred a client to that experience, they're certainly not going to go back to the affiliate either. So that's what our industry has basically, that's how it's performed for a very long period of time. And we're one of the few companies that have taken advantage of other competitors doing that and really screwing over the client for us actually looking after the client. So they've got a very high fixed cost model. They charge high commissions. They usually charge a fee to the client, could be from 3 to 10 grand, something like that, which they're not allowed to do that either. But either way, they do it. And, there's one transaction that they've milked everything they can from the client, and that's about all they'll see. And then they go and try and get a new client. So that's really what their business model is, and a very top heavy cost base. We've got a very low flat cost base. So our fixed costs are very low. We don't have fancy offices everywhere. All of our business takes place at the kitchen table. We have a team of independent agents that are actually all taking a lion's share of the commission. The commissions that we receive is no different to what Ray White or LJ Hooker would get on a transaction of a property sale. And we don't certainly charge our clients anything either. So a client will never get an invoice from us. Now, that means that we can actually go and source properties from wherever in the country that we deem to be performers. And a performing property from our perspective has maximized capital growth, maximized cash flow, and risk that can be mitigated, right? So and most risk is associated with cash flow as well. Not all risk, but most of it is. And so as a result, with a formula and with a matrix criteria, we can go, well, okay, where is the best areas for us to be sourcing properties? Where are the best properties for us to source? And then we can be dealing with the vendor, being a builder or developer or whomever it is, to actually be finding what is the best properties that can actually suit our clients. We arrange to make sure that we get paid the commission if our client does the transaction. We don't have a exclusive sales authority with that vendor, so therefore there's no pressure for us to sell it. So we'll have a list at any one time of 200 to 300 properties that have all met this very specific criteria, but we don't have an obligation to sell them. That list will turn over through the other sales channels that those builders and developers actually have. And you notice that the vendors are all builders and developers because we need them to be brand new, because 95% of our clients, they need the tax credits, right? If you're talking about 15, 17, $20,000 a year in tax credits, that's an enormous amount of cash flow after tax dollars, right? That our clients would have to earn to substitute to have established. Doesn't make any sense. If we're looking at clients that have got minimum incomes of $500,000 a year and they've got a couple $1 million to play around with investments, well, they'll be investing in a variety of different things as well as residential property, and they won't be so cash flow savvy. So they might look at positively gearing. They might look at all commercial properties. They might look at all different types of things. Obviously, those people still come to us as we're experts in residential, but for the most people, they're brand new properties, right? So it has to fit that part of the criteria. Now, if we were to describe ourselves to someone that doesn't know us, initially people mistake and they think that we're buyers agents. We're not. We're not taking a fee from the buyer, right? And we're not taking a brief from the buyer either. We're more like a financial planner, very loosely, that's using property as our vehicle to create the wealth and create the cash flow. And so therefore we've got a very similar process that we go through in terms of steps. We've actually got 6 steps that we go through. That first step is that fact find step that you would, a planner would do, or a financial advisor would do. We then assess in our next step to make sure that we've got a very clear understanding as to what their numbers are. So what their debt positions are, what they're earning, what they're paying in income tax, superpositions, all those sorts of things, so that we can work out what their affordabilities are. Once we know all of those numbers, then we're in a position to put together a strategy. And the strategy will obviously entail property. It will entail the cash flow elements of the property, as well as the potential capital growth elements of the property, and how that would look as a cash flow proposition to that potential investor. And we would also look at things like risk and risk management and the mitigation of risk. But very specifically, we would educate the client on the methodology we would use to source the properties that make our list. And that's a very important part of the process, so that they understand. So we're not guided by the client. The client's not coming to us and saying, can you find me a property in Newcastle? We would say, no, you've got the wrong people. You need to find a buyer's agent that specializes in Newcastle. We're getting an understanding from the client what their needs are. We're then presenting them with a strategy to achieve those needs. And then in the 4th step, we would then have another meeting where we're presenting opportunities to fit that strategy and fit their affordability and their requirements. And so there may be 2 options in that recommendation. There might be 1 option, might be a best fit. It really depends on the individual circumstance. And then from there, the client can make an educated decision. And then we go to step 5 in a subsequent meeting from there, where they're actually then doing contracts. Step 6 is then next steps, because there's obviously their journey is only just beginning, right? So step 6 is really important. And what we have is a very, very high reinvestment rate. So once we get to step 6 and beyond, future meetings usually entail them doing it again, because they've had a good experience the first time around, they've made money. And obviously you're not going to retire on 1 property. It's going to be a portfolio of multiple properties. So we want to be there for all those transactions. Now, our perspective on all of this is that we want to make sure that, if clients building a portfolio of 3 or 4 or 5 or 6 properties over time, we've built trust with them at the start. They've had a good experience. They're making money. There's no reason for them to go anywhere else. And that's why currently we've got around about 2,600 investors that have so far just invested shy of about 6,000 properties. So very clearly you can see that, that reinvestment rate. Also, because we're looking after the client, they're having good experience, and we've got that relationship, because we've got all of those independent agents They're with the client from the first phone call all the way through to step 6 and then beyond. There's clearly a relationship that's formed with that agent. And therefore, they've got an ongoing communication and relationship that builds, and they build their portfolio. The amount of time required for future property investments for all of those steps is far less because we don't need to educate them. They've gone through the experience once. They know what to expect. They know what our formula is. They know what obviously the original plan was. So the amount of time we're investing for the second and the third and the fourth transactions is far less. So we're getting a much higher return on our investment of time. The client has more confidence, and as a result of that, we're getting far more referrals from them and also from the affiliates, which I'll talk about shortly. So when we're educating the client, we're educating them on no predictions. We're not predicting the market. We're not trying to predict interest rates. We're not trying to do any of that. You invest when you can afford to. How do you know when you can afford to? The bank will tell us. And that's why that step 2 is so important. We invest in properties where someone always needs to live. So no matter what the economy is, where we think that the election outcome is going to be, what's going to happen with Trump's tariff, none of that stuff matters. It's always about where someone needs to live, and the strategy has to be around all stages of the cycle, which I'm going to talk about next. Very importantly, we need to maximize cash flow. So it can't be just about cash flow, because we need to maximize our capital growth, because that's where the wealth is created for the end game, which is in their retirement. But cash flow is really important to assist them with their current debts, could be their mortgage. It also is to minimize the risk on their current investment or the investment that they're making. And also, this is a get rich slow program. So there's no point having a get rich slow program where we map out 20 years and they get to year 7 and they have to pull out because the cash flow doesn't support it. So that doesn't make any sense. So we obviously are putting together a strategy with not a prediction, but an understanding that the cycle always moves in the cycle, and we go through all the different stages of the cycle. And this is what a lot of new investors don't really understand or address, whereas very experienced investors do. The biggest property companies like Stockland, all of those guys, they clearly understand the cycle. What we don't know is how long each stage of the cycle will go for and how big an impact it will have. That's what we don't know. So that's what we're not predicting. But we do know that at some point, interest rates are going to come down. Now, when is that? I've got no idea. Right? I've got an opinion. Everyone's got an opinion of when they think things are going to happen, and they'll have an argument for it. And if I lined up 10 economists in economics and said, well, when do you think it's going to be? I'd get 10 different answers, and then there would be an 11th reality. So I can't be putting strategies together for a client based on predictions, but it is based on the assumption that we're going through the stages of the cycle. So to give you an example, when we had very low interest rates, the market was booming after the GFC and the interest rates came down very, very low. The market was booming very hard. And for someone like myself, it was very frustrating because everyone is an expert. It's very hard not to make money in a market that's booming where the cost of the money is low. All right. So it's very easy to be an expert. Then when interest rates, and by the way, I would observe what people were doing and saying, oh yeah, it's okay for you now, but wait till interest rates go up and you'll realize what you just did. And so some people listened to that, some people didn't. But the long and short of it is that when interest rates started to increase, as we're all very clearly aware after COVID, then a lot of people did start to realize what they did or what they almost did. And then all of a sudden we got really busy because we got a lot of credibility based on the fact that they weren't thinking about the next stage of the cycle, and our strategies are for all stages of the cycle. And so what would happen when interest rates go up is that the heat is taken out of the buying market. More people are renting, and so the rental market dries up. The rents start to increase in price. And then in addition to that, this time round, we had a slow up of supply because of COVID. And they opened the international borders, and we've had record migration since. And so we've had a slowing of supply, an increase in demand, and interest rates going up, increasing the demand anyway. So we've got a rental crisis. So as a result of that, we've got a very unfortunate situation as a rental crisis where people are forced into homelessness, which is a disaster. And the government has a lot to answer for. But my clients are very, very happy because they're getting a lot more rent than what was initially anticipated. And what will happen is when interest rates come down, everyone's in pole position to go through then the cycle of growth. Because when interest rates come down, whenever that is, the confidence comes into the market. We go through a next cycle of growth, and people don't go out and discount their rent. So therefore, their margin increases on their cash flow as well. So rather than trying to predict, we get into the market. Now's the cash flow stage, potentially the end of the cash flow stage of the cycle, about to go through a growth stage of the cycle. But again, who knows when that will happen and by how far. Now, if we're trying to achieve the three things of maximize capital growth, maximize cash flow, minimize the risk, what I was taught by my mentor 30 years ago is a very simple formula, but it is much more complicated when we get down to the nuts and bolts of a particular property and a particular area. But for the intent and purpose of understanding it, we want a minimum yield in the area of 4% rental yield. The area must be heavily gentrifying. And as a result of that, there's net population growth of young working people. And so therefore the properties in the area are going to be new because it's an expanding population in that area. Now, when you have that formula, what I've observed for 30 years is the capital growth chases that yield. And that's what's happened and has happened prior to. When you look at the data, that's actually what the result is. And so that's the formula that we follow, and we don't ever steer away from it. And that will apply for a house, it'll apply for a townhouse, it'll apply for an apartment. Now, when I say apartment, don't think towers in the CBD, none of that garbage. It's all oversupplied, but it still comes down to supply-demand issues in unique boutique where there's a lot of, say, young professionals, not a lot of supply. Whereas houses, townhouses, it's more of the younger couples, younger families. Either way, they're all workers, and you've got a net growth with the gentrification in a pre-existing rental yield of 4%. With brand new properties. So that's the formula we've always followed. And to give you a couple of extreme examples, I mean, 2020 COVID, there was closed international borders, not a lot of gentrification around the country, except Southeast Queensland, because we could see all the local migration. So that's where we moved all of our activity. All of our sourcing was around houses in Southeast Queensland, townhouses and apartments. And any of our clients that invested in 2020, they literally doubled their value in 3 years. And a lot of people said, how did you predict that? We didn't predict it. We've never been through COVID or a pandemic before like everyone else, but we still stuck to our formula, and that's what we followed. So in terms of cycle and the economic stages, over time, whenever there's an effect on the stock market, and if that's affected in our future by tariffs, if it's affected by a change of government or whatever it is, I mean, we could potentially have a stock market crash, I mean, or a big correction. That's very possible. Then the money's got to go somewhere, right? And in what we've observed for a very long period of time is that when they're pulling money out of the stock market, it's usually going into cash. So it's going into banks or mortgage funds or those sorts of things. It's going into alternatives like precious metals, and it goes into real estate. And that's why you'll always see, after significant effects on the economy, and whether that's caused by the stock market or dot-com bubble, bursting, or an issue with our resources sector in Australia, there's always very, very strong residential property growth in the years that follow. So that's why we very much like to stick as close as possible to median house price. That represents 85%-ish of the population needing a place to live. And we're not looking at holidays related stock. We're not looking at luxury related stock. Plus, if you go luxury and you start going up in prices, you won't be getting the same sort of yields, and the cash flow comes off. So there's a lot of reasons for us not to be going there either. So same thing applies when the government gets involved. For example, Hawke Keating introduced negative gearing. They squashed it in 85. Negative gearing was first introduced in order to increase more housing for rentals to maintain lower rents, saves them money on having to build housing. So that's the purpose of negative gearing. It wasn't designed in order to make people rich, and rich people use positive gearing anyway, but they had to reintroduce negative gearing because rent started to spike, right, as a result of that decision or the disaster. So whenever the government gets involved, you can see that, they don't necessarily always have the best interest long-term for the country. It's usually for votes. and that's essentially what they're doing. So as I said, we've had record population growth, and that's what's driven sort of this cash flow model. Now, when we are working on these three pillars, basically, we've now come up with a reporting process where we can not only provide a written report to the client on an area, but we've divided it into 5 categories that we give a quantitative number out of 100 as to how it's scored. And when you read that report, you read the numbers, you can see literally how that has been impacted upon and why we're in that area, and why it got such a high score is because it rates very high on those 3 points. So that is something we've been doing a long time. Everything on it, just to let you know, everything on our list, the 200 to 300 properties that we have at any one point in time, they will actually have they'll have an 80 something net score. So everything will be between 80 and 90 that's on our list. Nothing will be below. And the only time it's ever got above 80 is, literally during that time during COVID, when it was just an anomaly. We had closed international borders. Everyone was going to Southeast Queensland, and we had some spiking, right, in that particular area at that time. All right. Now, as far as the affiliate program is concerned, we essentially have an agreement where our affiliates get a $5,000 plus GST referral fee. And the way in which I know I've seen companies in our industry offer big numbers, right? Which you immediately have to question, how do they afford that? And we now know how they afford it. So even the $5,000 we can't afford. By the time we've paid our own costs and paid the independent agent, we don't have $5,000. So the $5,000 comes actually out of the marketing budget of the builder or developer. So when a builder or developer does a budget to do a construction, they have to budget for an agent, for the agent commission, which we take, but they've also got a budget for marketing. And so that $5,000, we've got that builder or developer to agree to that to come out of their marketing budget. So in my observation, half of the builders or developers, they like to pay the affiliate referral fee directly to you. And then half of them don't want to bother with that. They'll actually pay it to us, and we pay it to the affiliate. But all of them will do an audit. All of them will actually make sure that that affiliate is not a bogus person or a mate of, the client, just trying to get a free $5,000. They'll just make sure that, it's a real company and it's a legitimate affiliate. And then obviously our established affiliates, some of our builders and developers get to know those same affiliates because they've paid them up 10 times. So keep in mind that 5,000 plus GST is per property. So if I've got a client and they're referred from an affiliate, and they ultimately over a few years buy 3 properties, well, that affiliate's getting 3 times that $5,000. And that's essentially how that works. So if we look at a couple of case examples with clients that have invested in properties that met that criteria that I spoke to you about with high city scores, I've changed the names of these clients, but it supports the point. So Ellen and Mary, they've actually self-employed. So that's why they're paying each other, or the way in which they're reporting their income is the same. So they're self-employed. They have basically they had an existing home that they had rented out that wasn't really performing that well. They ultimately sold that house and they've invested in more property. But when I saw them initially back in 2020, they had a $400,000 house, they had a small mortgage, they had only a little bit of super because they're self-employed, and they had a fair bit of cash. They ultimately invested in a property in Southeast Queensland for $580. They bought a house. We budgeted for their rent to be $550 a week. And it was between March 2020, the house was completed and built by June 2021. The value came in at $750, and they straight off the bat started getting $700 a week in rent. Now that property's worth 1.1 and they're getting 880, right? So that is an example of us following that formula. And that client, I didn't meet them until years later, face to face. All my dealings with them was on Zoom, and they've subsequently bought another 4 properties across 3 states. And they've referred all of their friends and family. Like I was working it out, their total referral pool, they've probably referred about 22 properties to me. But it's obvious as to why. I mean, they had a very, very good first experience. Now, I'm not going to promise that for all new clients because this is during 2020. But either way, we backed ourselves, right? We'd never been through a pandemic. Everyone was in a lot of fear. we backed ourselves and said, no, we're going to continue to follow this formula. And we didn't know it was going to be that good, but we knew it was still going to work, right? Because we could see where all the gentrification was happening. Another example, so John and Jenny, John's 51, Jenny's 45. He's on a wage of 130. She's on a wage of 90. Their house is worth 900. When I saw them, their mortgage is 140, 500 super. So he works for New South Wales government. She works for a childcare. They've got a 17-year-old and a 13-year-old. So in February 2023, they signed a contract for 669. It was an apartment, right? So they bought an apartment. This actually happened to be our Melbourne apartment, high city score. We budgeted for 630-week rent. They put down a 10% deposit. That's about to actually finish this year in June. And the valuation will come in anywhere between 8 and 850, right? Now, we budgeted the rent at 630. Comparable rents in that area now at 900 a week. So, you know, we never overpromised. We never promised those numbers, you know, when I saw them, you know, at the very beginning. And so obviously they're elated, right, with those numbers, and they've already referred another 2 clients to me, right? So this original referral came from an affiliate. It came from a financial planner, right? We didn't even sell them a property inside the super fund as their first property. This was the one that they could do straight away. And the financial planner is also a broker, so he did the finance. And that financial planner is now putting together an SMSF for them, right? And I'm due to have another meeting with them to sit down and go through the options and the opportunities for that self-managed super fund. But everyone's happy. The financial planner's happy. The client's happy. The 2 referrals, they've already referred to me. They're happy. And so we've got a very good track record. And like I said, I can't express to you enough, our whole agenda is the long game here. We'll make more money from a client by building a relationship and them having a good experience than making money. And our agenda with an affiliate is playing the long game as well. So what I've discovered, if you're a potential new affiliate thinking about joining us, there's 2 ways in which we can do this. I've had one, so I've got an affiliate who's a director of private banking at one of the top 4 banks. He obviously doesn't take the $5,000 commission. He just refers clients that are looking for residential properties in his, you know, amongst their portfolio. And I said, look, I can set aside 3 hours in a boardroom and I can walk you through all those 6 steps. And he said, yep, that's what I want to do. He's the only person that's asked for that. Every other affiliate that I've onboarded, I said, look, there must be 2 or 3 people you can think of straight away that you can refer to me. Why don't you just make that one referral, sit shotgun on the meetings, and then usually they get to about meeting 3 or 4 and go, right, I've seen enough. Great, this is really good. I'm really positive about this, Jason. How can we start talking to some of my other clients? And then we've sat down and worked out a program or a particular email. And that's why I've actually started to do these affiliate webinars where I'll start to actually do intro nights for new referrers. Right. So if you've got a referral that you don't want to introduce to us directly straight away, you can just literally send them to an affiliate. An affiliate referee night or an intro night where I get to introduce our company and sort of our policies and our processes to the potential referee, and then we can actually have a one-on-one meeting with them after that. So it's a softer way to introduce. Either way, I spoke to a new affiliate yesterday and they said, Jason, I really like what I hear. I've got 3 people I can actually refer to you straight away. I said, well, look, you don't refer 3, just refer 1. Let's go through that process together and then let's talk about the other 2. And we can have a chat about the agreement and everything required sort of from there. So he was obviously very happy with that. And that's the way I've enrolled hundreds of affiliates, right? Is just when you got your first referral, then let's do the agreement and then let's book the appointment and let's go through that process. All right. So what we'll do is we'll make sure that this recording gets distributed to all of our existing partners. I'm going to be doing these every month. And obviously, in my next meeting next month, I could be referring to a change in the market. We could be talking about different interest rates. Could be a change in government. Who knows? But either way, it's a good opportunity each month for us to show you guys the difference in direction of strategy that we take our clients, and then what the outcome is in terms of potential projects or potential investment opportunities and how that is actually affecting our opportunity to source performing stock. So until then, I'll see you guys in a month, and refer to your executive manager or a partner in our business, our licensed agent, for any more information, or myself. All right, guys, thank you very much. All right.